These macroeconomic charts will blow your mind. Backed by popular demand, we're taking a look at what is really going on behind the scenes in our financial markets and answering the all important question of, is 2023 about to repeat the exact same pattern as 2008? Right? We had a financial collapse in 2008 brought about by the Federal Reserve tightening interest rates way too high, mortgage costs ballooned, and the entire housing bubble popped. Well, they're doing the exact same thing now. They're raising rates and the economy is falling apart. So let's look at the fundamentals beneath the surface of what is going on. 1 year sovereign credit default spread spiking. The need for protection against US default, right? So huge problem. We see it spike in 2008. We see it spike in 2011. Those were both panic points. Then 2014, and it spikes whenever there's a problem. Well, it just spiked again massively, right? In 2023. Look at this up move. So clearly people are buying protection against a US default this year. The Philly Fed Manufacturing Index also proving weakness, just like it did in 2008, making the same pattern, nosediving like it does whenever there's a problem. The pandemic, 2020, the 2001 recession, the 2008 global financial crisis. Here we are again, making the exact same move, all at a time when bankruptcies are spiking among small and private companies in 2023, making a new high. So companies are going bankrupt faster than 2020 during the pandemic. And if that's not bad enough, the banks are undergoing severe stress, the deepest contraction ever in commercial bank deposits. Okay, so look at where we are now. Look at where we were in the 2008, 2009 global financial crisis. People are trusting banks even less right now. They're taking their capital out even less. Now, the main reason for that is because you're not getting a good interest rate on your deposits in banks. So they're putting them in money market funds. But that's a problem for banks, right? We've seen banks explode. So the Federal Reserve has had to turn on the money printer. And so what we are looking at is a situation very similar to 2008, a rotting economy, right? Now, the most important point to make in this economy is that the fundamentals only matter in the short term, because in the long term, the Federal Reserve and the governments manipulate financial markets by debasing the currency. And we are completely and utterly correlated to what the Federal Reserve is doing, right? So that's why when we're trying to answer if now is the same as 2008, well, we have to factor in what the government is doing. And it's very important to stay on top of this. Let's use Bitcoin as an example. Bitcoin, tech stocks, they all have done pretty well in 2023. Well, look at how correlated Bitcoin is to the Fed terminal rate. So we have Bitcoin in yellow, the Fed terminal rate in white. And what we are seeing is the Federal Reserve terminal rate collapsed. This was around when SVB and the banking collapse happened. Why did the Federal Reserve term rate collapse? It collapsed because people were thinking, well, the inflation picture isn't bad anymore. We have a banking crisis on our hand. And so the interest rates fell. Remember, interest rates are the oxygen of the financial system. So when you have a massive down move in the Fed terminal rate, Bitcoin responds, tech stocks respond. So you have Bitcoin rising from 20,000 to 30,000 on that dip in the interest rates. That's how correlated it is. But guess what? Now the inflation problem is not going away. Interest rates are starting to climb back up, right? So we see the white line starting to climb back up. Lo and behold, Bitcoin's collapsing from 30K down to 27K. Here's another way of looking at it. We know how correlated the Fed's balance sheet is to assets. Well, we had this big positive spike up in 2023 when they swept in and saved the banks, right? They turned the money printers back on. We've been dealing with this downturn all through 2022. Well, they just turned the money printer back on, reversed a year's worth of monetary policy, printed money. Again, that is why assets overall, financial markets pump. Well, guess what? Now they're coming right back down. And so if they keep the money printer off, if they reduce liquidity while the fundamentals of the economy deteriorate, like these charts are showing, then there will be another collapse. That's just how this works. Now, that is in the short term, right? The next few months in 2023, probably one more massive collapse that forces the Fed's hand. Richard Fisher, a former member of the Federal Reserve, came out and said, unemployment still low. That means there's plenty of cash flowing out to the consumer. And he's saying because unemployment is still low, around 3.5%, the Federal Reserve can still tighten, right? That's what they're hoping for. But he kind of gave away what the Fed's cushion is, right? It's unemployment. So as long as unemployment stays low, the Fed can continue tightening the economy. Now, what happens if unemployment picks up? What happens if the fundamentals of the economy start to come to light? The deteriorating balance sheet, the bankruptcies, and then unemployment spikes. Well, then the Fed is completely and utterly out of options. They're going to have to revert to their old long-term trick. Again, long-term, this is what happens. They print money. Look at the M2 money supply in billions from 1960 to 2023 now. We've had a massive, massive up move. There's a reason the stock market has gone exponential along with the money supply, because the currency has been debased. Assets have gone up in price because they're priced in US dollars, which are inflating like crazy, absolutely exponential. So this is the long term, right? We're talking about the short term. There's going to be a massive collapse, and then they're going to turn on the money printer like they've done in the past. We're on this exponential money printing curve. That's going to raise all boats, all assets. That is the nature of a centrally planned and manipulated economy. This is the game we're playing. What is the government going to do? What is inflation going to do? At the end of the day, they're going to choose inflation and currency debasement over economic depression. And so as long as unemployment stays low, they're going to be able to keep liquidity tight. But as soon as unemployment spikes, as soon as people start getting laid off, they're going to turn the money printer back on, and we're going to ride this exponential up curve. So place your bets, decide what assets you want to hold for the long term, because the money printer is going to be turned on. Inflation is going to be the new normal, and we're just going to go back to the same game we have been playing. But in the meantime, expect massive volatility as this all shakes out. Thank you guys for watching. Appreciate you. More content coming your way. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.